Hey, everyone. Good afternoon. Thank you for joining us here today. Thank you for your patience while we just worked on some of our little problems. I am happy to be joined with a good friend of mine and a business associate, Eric Stewart. Eric is with Atlantic Business Capital. Eric and I have worked together as I was his customer for some multifamily deals, as well as we worked together where some of my clients in my law firm have worked with Eric to procure funding for their multifamily deals. So, Eric, how are you?
Doing great, Charlie. Thank you very much.
Good, good. What we're going to talk about today, and I've asked you to be on the call because I know you're going to add a lot of perspective. Um, the focus today here is really on creative and inexpensive ways to fund multifamily deals. And we're going to talk about some creative ways. We're going to talk about some non-creative ways, but they're inexpensive. Well, I got a little. Eric, do you have your speaker up, or do you have a headset? Because I'm getting some reverberations here.
I don't have a headset. Let me turn my volume down a bit.
Okay. Um, what what we're going to talk about are five different ways that we can come up with to creatively acquire multifamily property. Now, as a multifamily investor, I can tell you that the moment you start making offers is the time you have to start thinking about how to get a deal financed. It is too late during the purchase and sale stage. When you make the offer to the seller, you've got to try to figure out exactly what are the ways that I'm going to be able to get this deal done. And the number one criteria that you've got to always bump up against are ways to finance the deal. So let's talk about different ways that you can get creative with financing. Now, first off, and this is great that we have Eric on the phone here because he sees this on a regular basis, is seller financing. And what does this really mean? What we see, I can tell you right now, virtually, and I say virtually, all of my students who are involved in deals right now have some form of seller financing in the deal. In other words, when they were making their offer, they made the seller come to the table with some type of skin in the game as well in order to get that deal to work. Now, what does seller financing actually mean? It can mean anywhere from 5% to up to 100% of the purchase price. Now, typically you'll see 5%. That's an easy one. The banks don't seem to, well, we'll talk about that a little bit more in a moment. Banks don't seem to have that much of a problem with 5% seller financing. But when you start getting up to the 100% seller financing, you've got to ask yourself the question, why does the seller need to finance the entire deal in order to make me the new owner of the property? When I see anyone coming to me with a deal where the seller is willing to just turn over the keys and give it to a new buyer, a red flag goes up in my mind that there must be something wrong with that deal. First off, that it can't be conventionally financed. And secondly, that this seller is willing to just let it go for no cash out of his pocket. So we're looking at the entire spectrum here from 5% all the way to 100. Five is normal. You can handle five. 100%, that gets a little bit risky. So beware when you see that type of a deal. Now, let's talk about things to be aware of. And these are the things that you don't quite think of when you're making the offer. But as I said before, you've got to consider the financing when you're making your offers. First thing is never, never, never offer a second mortgage in a purchase and sale agreement. Eric, do you know why that is? Why I tell my students that?
No, I'm interested. I'm interested.
Okay,
This is
this
this
is
is
new to
amazing.
you. Okay, here's why. And Eric confirmed this as fact. Banks will not allow second mortgages. Fannie Mae will not allow a second mortgage on a deal. Is that a correct statement, Eric?
That is correct. Yes.
Okay. So if you are going to get conventional financing, if you're going to go to one of the agencies to get a loan on this deal, if you're wholesaling a deal and you're making an offer to the seller in such a way that you're looking to get some form of seller financing, do not limit yourself by calling it a second mortgage. When you do that, you've just set yourself up for failure in the financing process. Now, what will happen is in the letter of intent stage or in the purchase and sale stage, you say to the seller, "Hey, I'd like to get some type of seller financing," and the seller says, "Okay, that's fine. I'll offer you 10% of the purchase price in the form of a second mortgage." And you say, "Okay, great. We'll do a seller second of 10%." You write up the purchase and sale agreement. You go through the inspection process. You get finish the inspection period, and you realize, "Hey, I want to buy this property." And then you contact a guy like Eric, and Eric goes to work for you to find the financing to put this deal together. And what happens after 30 days or 15, 30 days is the bank will come back and say, "You know what? We like this deal. We're going to do this deal, but we can't do a seller second. We will not allow a second mortgage on this property. We will not allow any other entity to have foreclosure rights on our property. So we'll do this deal, and we're okay with seller financing of 10%, but we won't allow you to do it in the form of a second mortgage." So what do you have to do? You have to backtrack. You have to go back to the seller, pretty much hat in hand, and ask them to rewrite the terms of the offer. And you better hope that you've got a very compliant seller who's willing to do that and not have it cost you out of your pocket. Because that could happen. The seller could come back and say, "Well, if you want me to rewrite it, then we're going to go up in the purchase price. Or you're going to have to put more money down, or your earnest money has to go hard today." You could put yourself in that position where a seller's second mortgage ends up really hurting you. So make sure you can always ask for seller financing. Just don't limit it to a second mortgage. And if the seller says, "Well, how do you expect to pay me back?" You just say, "Well, we'll have to figure that out when we get to that stage. But right now, I can't offer you a second mortgage because the banks won't allow me to do that." So that's one thing you need to be aware of when you're dealing with seller financing. Another thing is, and Eric, help us out with this one. Understand what a PG is, and do everything you can to avoid it. Now, Eric, what's a PG?
When you see the letters PG, they're talking about what's called a personal guarantee.
Mm-hmm.
The other term for this is recourse, and that essentially says that you are putting up your personal assets as the guarantee that the payments are going to be made on the property, that the promissory note is going to be fulfilled. Um, the the majority of the loans that I see go through right now are non-recourse, meaning there is no personal guarantee, meaning they're not going to chase your personal assets should they have to take back the property. They're just going to take back the property, barring any specific events, barring fraud or major environmental issues or negligence, things like that. They're not going to come after you personally. Now, do everything you can to avoid it? Yes. There's some specific areas that you can focus on to know what you're getting into, like the dollar size of the deal. Loans over $1 million that are stabilized, we should not have a problem getting non-recourse financing. Loans under $1 million, we're very limited as far as the lender bucket to find non-recourse financing. It's out there, but they're few and far between, and they're right your loan requests over $1 million. So those are some areas to focus on. I mean, portfolio lenders, local regional banks, always going to be recourse. Plan on a personal guarantee and a full underwrite. Your Fannie, Freddie, FHA, and conduit lenders, typically non-recourse. If a loan's getting sold in the secondary market, typically you're not going to have a recourse. You're not going to have a recourse guarantee.
Right. Now, keeping this in the context of seller financing, I just, when I mentioned the clients of mine, the students of mine that are involved in deals right now that have some form of seller financing, what I'm surprised to see is a lot of these sellers are coming back asking for personal guarantees. I mean, that's what we're seeing, and it, as I said, you try to get out of that as much as you possibly can. So the sellers are wising up. They want to make sure that you've got some real skin in the game. And you as a buyer need to be savvy and try to get out of agreeing to any type of personal guarantee possible. So let's move on here to the next things to be aware of with seller financing. Oh, and this one actually happened to me just the other day. When the my student was talking to the broker about seller financing and about maybe making this deal happen via seller financing, the broker's reaction was the seller will be more than happy to finance the deal himself. He's already done it before. And so right away, to me, that sent up a huge red flag. In other words, if he's already seller financed this particular property before, and now he has it back in his possession to be able to sell it again, he's already once foreclosed on this deal through a private loan. So he's already had to take this property back because it didn't perform the last time. So you've got to ask yourself the question, why am I any better than the last guy who did this deal and lost the property back to the original owner? What makes me think that I can do a better job managing this property? Now, the guy may have purchased the property and it was too high of a purchase price and the numbers didn't work out, and he could have had his own problems. He could have been a lousy manager. But he could have been the best manager in the world and still lost the property because he couldn't perform under the terms of the note. So that sends up a red flag to you as an investor. When you start to negotiate with this seller about the terms of that seller financing, make sure those terms are going to work for you. Everything, and as we say, everything with seller financing is negotiable. I mean, the term of the loan. And remember, I've got term and I've got amortization rate down here. You've got to understand that those are two separate terms. The term is the length of time that you have to own this property before you have to pay back the note. It could be a 5-year term, it could be a 10-year term, it could be a 30-year term, which is different than the amortization. The amortization is the amount of time that the principal payments are spread out over to pay back the principal of the note. So if you have you could have a 10-year term with a 30-year amortization, or you could have a 5-year term with a 25-year amortization. So all of these terms are negotiable with the seller, and you always want to try to get it, the longest amortization possible. And if you can, try to do an interest only note. That way, you'll never have to pay down the any principal, and the property is just going to perform like you were renting it. Another thing is the interest rates. Negotiate the interest rates. One guy came back with seller financing the other day for 6.5% because that's what the seller had offered 5 years ago as an interest rate. Well, that seller is not savvy enough to know what the market is bearing right now. If you got Eric, if I told you I'm looking for a deal that's a 6.5% interest rate, what would you tell me? What's the market bearing right now for interest?
Well, there's Charlie. One of the things we want to keep in mind too is number one, what he can get on his money and what type of annuity that's providing for that seller.
Right.
He's earning 6.5% of his money, aside from sticking it in the bank and earning 0.25% on that deposit. He's doing quite well. If in fact you had to go to a bridge lender to get this loan done, you're looking anywhere from 8 to 12%. So it really is going to be property specific as far as what type of rate he can what kind of rate tolerance he's going to have. It also comes down to what type of underwriting he's going to require. Is he going to require a personal guarantee? Well, I'm going to get a lot better rate if I'm putting up that PG.
Exactly. Well, right. If he's requiring a personal guarantee, your cost of borrowing the money should come down because the risk has now come down for the seller. Now, Eric, what if it's a conventionally financed loan? What type of interest rates would we see if this were a standard bank loan? I mean, would
standard local bank loan, which is going to be the most comparable to what your seller financing is going to be, you're looking anywhere from between 4.75% and 5.25%.
Right. So you're seeing
5-year fixed period.
Right. So you're seeing a much lower term interest rate. If this, for instance, in this particular case, guy was looking for 6.5, and we said, forget about it. I mean, it's so much cheaper for us to actually go to a local lender than it is to borrow from the buyer, from the seller. And keep in mind too, everybody uses this term, the annuity, and what's it? what does it compare to? When a seller does seller financing, he is getting the best type of annuity you possibly can. He is getting a fixed certain annuity with what's called a refund after a certain amount of time. You go to an insurance company and ask for that type of an annuity, and you're going to get the least amount back because it a least amount of a monthly payment from the insurance company, because that's one of the most expensive types of annuities to buy. With when the seller is financing it himself, in that way, he is making out like a bandit. So if he can get 6.5% on that type of a deal, no insurance company for offering an annuity could even touch that. So the other thing is down payment. As I mentioned before, you can do seller financing from 5 to 100%. You can negotiate with the seller as to what how much down you're willing to put into the deal to make him sell the property to you. So, I've gotten in deals where we've done no money down. I've gotten in deals where we've done 25% down. It's really another term that's easily negotiable. And then finally, the interest only payments. Remember, interest only payments are going to make your numbers look great from a cash on cash standpoint, but you're not paying down any of the principal. At the end of the term, you're only going to realize that amount, the sales price over the purchase price, 5 years down the road or 10 years down the road. So you're not building up any equity when you're doing an interest only payment. So just keep that in mind when you're running your numbers. It'll make your cash and cash look great. It doesn't really help out your internal rate of return all that much. So, Eric, have anything more you want to add about seller financing?
I can offer a little story that really
We love
backs up what you were
stories.
talking about as far as the annuity. It's we were trying to refinance a seller note, and it was a little Asian lady, and she had structured this note as her retirement, and she saw that income every month. It was a doctor's office, and when she heard we were going to refi it, she started fighting, I eventually I didn't get the deal done because she was competing with us.
Isn't that
She was
wild?
competing with us, and she was tough. She was tough. So
Wow.
you're not you don't necessarily have to be hat in hand when you're asking for seller financing because you're oftentimes doing them a service.
Exactly. Isn't that wild that you were coming in to offer her a lump sum payment. Here's all your money back. And she didn't want it back. She liked that monthly cash flow better.
She dropped her rate lower than we could.
Yeah, exactly. Because she loved
She
that
dropped
cash
her
flow.
rate lower than we could and got the deal.
That was like,
Yep. Yep.
I'll tell you, I was, a friend of mine owns a self storage facility. And I told him, I said, listen, when you're ready to sell, I want to buy it from you. And he goes, okay, great. And so, we talked about it. I'd see him at lunch every once in a while. And one day he's having lunch with his wife. And I made the mistake of walking up to him and say, hey, when you're ready to talk about that, just let me know. Just get me over the financials. And his wife said, what are you talking about? And he said, oh, Charlie wants to buy the self storage facility. She goes, oh, no, 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 that's not for sale. You're never selling that. I like that money every month. And I was like, oh, darn it, killed the deal right there. So we never got to talk anymore about
Right.
that. So, oh, who knows? Now, let's talk about another type of funding source for multifamily deals. And these are what, in the business we call agency funding. So first off, what are the agencies? As I like to say, I'm from the government and I'm here to help. So Eric, let's talk about some of these. Why don't you hit a couple of them? You're the expert on these agencies.
Well, specifically when you reference agency financing, you're referencing Fannie Mae and you're referencing Freddie Mac. Those two are actually purchasing the notes in the secondary market or purchasing them from their lenders. FHA is really just an insurance policy that they're offering for another lender's loan. Haven't done a lot of USDA over the years. They're limited as far as location and where you can get those done. Um, I, I'd like to look into them a little bit more, but it's primarily in rural communities. But I haven't done a lot of those. But Fannie and Freddie is really what the core market is. That they're the lead dogs, and then FHA's in there as well.
Right. And one thing that we talked about is, the topic.
That's what you're talking about.
Now, one thing that we talked about was the fact that the name of this talk is creative and inexpensive ways to fund. Now, uh, the beautiful thing about these agencies is that it is very inexpensive. The difference, though, is that it's not creative at all, um, and the interest rates. So I'm still getting a little feedback from you, Eric. So
Sorry about that. I'm turning my volume down again.
okay, so they're not creative at
I don't
all.
have a headset. My phone.
Okay, they're not creative at all. Um, they're pretty cookie cutter, as a matter of fact. One of the differences that we would see is depending upon who the DUS lender. That's a DUS, Dobbins Underwriting Services, Delegated Underwriter and Servicer is what a DUS lender is. Those are the people that provide you with the Fannie Mae paper. When you go to work with Eric, Eric has contacts with all of those DUS lenders, and he can bring you to the one that provides you with the best terms. So, Eric, when we say that Fannie Mae is not creative, um, I got to tell you that what we've seen though are some subtleties behind the scenes regarding the creativity of the DUS lender. For instance, you put us with a particular DUS lender who has turned out to be great to work with. They provided us with a Fannie Mae loan, but on a regular basis, on our daily and a monthly interaction with that particular DUS lender has been different than all the other lenders we've ever worked with. And they have come up with some creative things that I'm wondering if they're unique to them or are they unique to Fannie Mae. Case in point, they allow us to recoup our reserve replacement on a monthly basis. Some other lenders were requiring us to recoup our reserve replacement on a quarterly basis. Is that unique to the DUS lender? Is that a Fannie Mae deal? How does that work?
Well, it's a great point. It's an interesting point. Is there are approximately 26 approved DUS lenders out there right now, and there is a certain level of appetite. And there's also servicing companies out there that they use to serve loans. There's variances between them depending on the region, the dollar amount, any special tenant base that there might be in the property. We need to know which lender to go to, who's going to have the best appetite. I'm not going to send another Los Angeles to the same lender. A $10 million loan in say, they're entirely different appetites. So that's really correct. It's going to vary from lender to lender.
Okay. Whoops. Sorry, I jumped ahead there a little bit. Eric, we're getting a complaint that you're a little hard to hear, and I can understand as well. It's not with your microphone or anything. It seems to be more with your connection. So let me try to keep this going and see if I can touch upon some of these things as best I can. Okay. Yeah. So let's talk about some more of the agency lender issues. They can get kind of aggressive on their loan to value. When I say aggressive, they're not going to be that aggressive, but they tend to be more aggressive than let's say, a local lender. So, for instance, if a local bank is offering a 75% loan to value, Fannie Mae might have an 80%, and sometimes even, and I've heard this on rare occasion, a an 85% loan to value program. The thing that you want to be aware of whenever you're talking to a lender is if you're speaking to one mortgage broker who's telling you that he can do a deal at 80%, and you're speaking to another broker who says he can get a deal done at 85%, meaning that you're only going to come to the table with 15% down. Um, you got to raise, behind the scenes, these guys all tend to work with the same sources. So you've got to make sure that the person telling you the great story isn't just trying to sell you into his company so that you have to close with him. This happened one time to us where that exact scenario was coming out where the broker was telling us he could do the deal for 85% loan to value. And I can tell you, it was Eric that actually was on the other side saying it can't be done. And when it was finally all the cards were laid on the table, the other broker realized that, no, you know what? I can't do this deal for 85% loan to value. I can only do it for 80%. And that really killed this guy's credibility quite a bit. So make sure you understand what types of loan to value you can get for that type of property when you're making the offer. The other thing, too, as Eric had mentioned before about the personal guarantees, and when you're dealing with agencies, some of the federal government agencies, not the federal government, but the third party agencies, you don't have these personal guarantees. They're non-recourse loans, except for those situations with the bad boy provisions. And Eric, what are some of the minimum amounts necessary for Fannie Mae and Freddie Mac? I know they have this small cap program. Okay, I think we're having a little issue with Eric's speaker. So I tell you, let's go to the master lease option. This is going to be the next one. And as Eric likes to call it, he calls it the next one. As a matter of fact, I'm going to hear myself. Okay. As Eric likes to call it, he calls it the anti-loan program. Okay, there we go. So what that means is that he never sees these types of deals. Eric, as a lender, never sees these types of deals until they're looking to be refinanced. The key about a master lease, and for those of you out there listening, we've written a program on master lease options. It teaches you how to do it. It provides you with all the forms you need to be able to go out there and market for it. The key thing about a master lease option is to know your exit strategy. So that means that before you go into buying this or getting this deal under contract, how are you going to get out of it? And not only how are you going to get out of it, but how much money is it going to take to turn this property around? Where is that money coming from? And do you have those funds readily available in order to make this property a success? So one of the complaints, or not even a complaint, but one of the issues I see among new investors, somebody goes out there and buys our program on master lease options, and they send me an email and they say, how can I start marketing to multifamily properties to do a master lease option? How can I find a list of properties that would be perfect for a master lease option? And the answer is, you don't do it that way. If a list ever existed of properties that would fit for a master lease option, you couldn't pay enough money to buy that list. That list would be gold. And that list just doesn't exist because there are so many characteristics and criteria that are unique to that property that you'd never know whether a master lease is actually the right option for it. In other words, a master lease option is not your lead. It should be a tool in your toolbox. Your lead should be, I want to get out there and meet the owner of this property and help him transition away from this property so that I can take it over somehow. And using a master lease option is the easiest way to do that. But the thing about a master lease option is you want to take into consideration the term. How long are you going to have to hold that property? The longest term that you should, the shortest period of time that you should do for a master lease option is 3 years. 5 years would be perfect. Less than 3 years, forget about it. Don't even bother getting involved in the deal. The other thing about the master lease option is you want to consider about down payment. Now you might think to yourself, well, wait a minute. Um, I thought I could get into a master lease option with no money down. Well, what I'm talking about isn't the down payment or any type of funds at the closing of the master lease. What I'm talking about is every month that you own that property, that you control that property, you're making a lease payment to the owner. Wouldn't it be great if you could structure some of that lease payment as a down payment at the closing? So it's kind of like, with these single family home deals, at least with an option to buy, where, your monthly payments go towards building up a down payment bank for you. The same thing could be true in a multifamily master lease option as well. So a master lease option is another way for you to get creative with a seller about taking over their property. The other thing too is that, remember the things we talked about as a seller financing at the beginning of this discussion. A master lease option, the option portion of that deal can be set up and structured so that there's seller financing involved as well. So you could have the best of both worlds with a master lease where you get control of the property for no money down. Your monthly payments go towards building up your down payment at the closing. And then at the closing, the seller is still going to give you some form of seller financing based upon what you negotiated at the very beginning. So a master lease option can get pretty interesting. And it's, once again, you can get very, very creative. Everything is negotiable. Now, I'm going to bring Eric back online here because we're going to talk about bridge financing, and this is really his specialty. Um, the thing about bridge lending is, Eric, I just brought you back online here. So I'm wondering if you can kind of share with us a little bit about the bridge lending and the transitional financing.
So what if you can kind of share with us a little bit of
Hey, hey, Eric. You know what? Let me just tell Eric to.
Headset. Is that any better?
Oh, good. Yeah, that's great. Can you hear us? Okay. You know what, Eric? I'm going to ask you to go back on your dashboard there, and it'll give you a section that
Does
tell.
sound bad.
Okay. You know what, Eric? I'm going to ask you to do is, if you can go to the audio portion of your control panel and just click on the telephone, and then it'll give you a phone number to dial in on, and a bridge number, and then that way you'll be able to you'll come in on a telephone line instead of through the computer, and the sound might be better. So hopefully he got that message.
All right. You're talking to me. It's fading in and out pretty hard. So yeah, I'll on this other number.
Yeah. Okay. Try that telephone number, and we'll see if we can get you back online that way.
I'll click on this now.
Okay. All right. So when Eric comes back online, what he's going to talk about is bridge financing, and this is a term that you'll hear quite a bit when you're talking about, especially with rehab deals or deals that need to be closed very quickly. I asked Eric the question earlier about, well, what's the real difference between hard money and bridge financing? And the way that Eric described it was kind of like the old geometry days, where you've got one, all of B is in A, but not all of A is in B. In other words, all hard money is a form of bridge lending, but not all bridge lending is a form of hard money. Eric, are you there? No, not yet.
I'm still on. Yeah. I don't know if you can hear me.
Yeah, I can. Are you trying to dial in using your telephone? Okay. So when you're looking at doing a deal and you've got to close quickly, we've got a couple of deals where the people are looking to close before December 31st because of the capital gains. It becomes very challenging in order to do that. And a conventional lender, you can forget about it. It's not going to close by that time. But what you're going to end up doing is using a bridge lender or a hard money lender, who's going to be able to close that quickly. They can close, some of these guys say that they can close in 14 days. Let me just check here. But to use it on a conventional deal is highly unlikely. And because when you do it on a conventional deal, it's very expensive money. A conventional deal, you'll look at a Fannie Mae at a 4.5% interest rate. A hard money loan, you're looking sometimes at 8 to 12% interest rate with some pretty oppressive points built in there as well. So it can get very expensive. So there's really only two times that you're going to use a bridge financing situation. You've got to close quickly, or it's a deal where you've got to get in there and you've got to rehab it and you've got to stabilize it. Now, how do you know if a deal is going to be the type that needs to be rehabbed or stabilized? And those two terms do not have to be used in the same sentence. It could be a deal that just needs to be stabilized. It's already been rehabbed. The property is just not performing. And here's the rule of thumb. Typically 80%. 80% occupancy is going to be the rule. For an agency type deal, you're going to need to see 90% occupancy for 90 days, 90 for 90. And with those types of numbers, you'll be able to get a deal conventionally financed. If it's below 80% occupancy, you're going to have to get some type of a lender who's going to stabilize that, who's going to agree to get into a deal that is what's called non-stabilized. If it's below 80%, you've got to get out there with a bridge financing situation. Otherwise, you'll never be able to get that deal done. So when you're working your numbers, if the rent rolls show that the occupancy is below 80%, you've got to build in some pretty expensive financing terms in order to make that deal happen. And always remember, you've got to figure out what your exit strategy is before you go into it. And if the plan is to rehab and reposition that property, you've got to be very conservative and very realistic on what the expenses are involved in turning that property. So as you're making offers, bird dogging, wholesaling deals, you've got to take these things into consideration when you're making your offer. Remember, you've got to negotiate a very solid deal in the wholesaling stage in order to be able to sell that deal to an end user. So make sure that that you take these things into consideration when you're looking at a particular deal. Other things regarding the let me see, regarding, oh, hold on, let me go back here. Other things regarding the bridge of hard money loans are the fact that you are going to deal with personal guarantees. So just get used to it. And then also the regional lenders. You're not going to find a national lender for bridge financing. That's why working with a guy like Eric, who knows who the players are in the different regions, is so beneficial. That way you don't have to go out there and educate yourself to what's going on. Your guy like Eric is the one who's going to be handling this for you. Now, let's talk about assumptions. Now, much has been said, much has been talked about as assumptions could be the great panacea for new investors. This is a way that you can walk in there and just take over the existing mortgage of a multifamily deal. Let me first explain the difference between an assumption in a multifamily deal and the equivalent of an assumption on a single family deal. On a single family deal, you've got that due on sale clause, and everybody kind of runs in fear of this due on sale clause, that the bank may trigger that due on sale clause in a single family transaction and may call the note. And I don't know how often it happens. The single family world is not really my arena, but I'm here to tell you right now, folks, that the exact same provision can be found in virtually every multifamily note and mortgage, the equivalent of a due on sale clause. And let me just tell you, in the multifamily world, it's a different world. They will call the note if they find out that there's been any shenanigans going on with switching the owners of the policy. owners of the property. So don't do it. Don't try to pull a fast one on the existing lender. The way to do it and the way to do it correctly, there's really two ways of doing it. You can either do an assumption or you can do what's called a substitution. And the substitution is when you are purchasing the entity, the business entity that owns the property. You still have to go through virtually the same approval process, but it's just handled slightly differently. So if you've got this assumption, we're just going to be talking about an assumption because that's the wording that's dealt with strictly in the mortgage and the note documents for the property. With an assumption, what you're doing is you're filling the shoes of the current borrower. Now, here's the problem with that. How big are those shoes? Well, who knows? Well, you've got to fill those shoes. Okay, well, tell me how big those shoes are. How much did the seller tell the lender he was worth back when he took out the note? Well, how do you know? You don't know. That's the problem. What happens if your feet are too big? What happens if your feet are bigger than the shoes you're trying to fill? That's a nice problem to have, but it still becomes a problem. Because remember, the bank wants you to just fill the shoes. Well, if you overfill the shoes, and then 5 years down the road, you want to sell the property and have someone else assume the note, now that new person has to fill your shoes. And because your shoes are bigger than the last guy, you've just narrowed the marketplace for who's be willing to buy this property. These are the types of things you got to take into consideration when you're sitting there talking about the different ways of financing a deal. These are the problems. Everybody say, hey, let's do an assumption. Okay, what does that exactly mean? When do you do an assumption? You do an assumption when the existing owner has prepayment penalties on the note, and it's too expensive for him to allow those prepayment penalties to be paid. And I tell you something, folks, the way these prepayment penalties or defeasance or however they're termed in the document, these prepayment penalties can get pretty onerous. It can be. I've seen prepayment penalties on some deals to be as much as $500,000. In other words, if the seller was going to sell you the property for $10 million, $500,000 of the equity that he pulls out of that $10 million sale goes right into the bank's pocket, not into his. So the seller is going to think, well, how can I don't want to pay them $500,000. How can I get out of this deal and get to keep that $500,000? What the seller has to do is they've got to find a buyer who's willing to take on the existing note. That's what an assumption is. And the thing you need to understand is that an assumption really benefits the seller. It does not benefit the buyer. Or it could, but most of the times you're just taking over a already negotiated deal. You don't get the opportunity to renegotiate any of the terms. And so you're stuck with what that guy negotiated 5 years ago so that he doesn't have to pay $500,000 in prepayment penalties. Sounds like he's getting the benefit of the bargain and you aren't. Well, that's a fact. So what you have to do is you need to go back and negotiate hard. Don't think that accepting an assumption from the existing seller is good for you. It's good for the seller, and it should come at a price. Now, one of the things is that you don't when you go into an assumption, you don't have an advocate on your side like an Eric Stewart. Eric Stewart gets paid when the deal closes on a new money purchase. On an assumption, it's not a new money purchase. Nobody is going to get paid a commission for making that deal go through. So nobody is your advocate in the process. So that's something you need to take into consideration, that you're going to be going this alone when you get into an assumption deal, if you really want to make that happen. And that's something else. If you're looking to wholesale the deal and you've negotiated an assumption, you've got to make sure that whoever you wholesale the deal to is going to be qualified to be approved for that assumption. Now, the other thing you want to take into consideration are the fact that what are the costs involved with an assumption? Well, you're still you're still having the you're still having the problem, the 1% assumption fee. So with you may be able to get out of paying a lot of the third party expenses, but you still are going to have to pay a 1% assumption fee. There's just nothing you can do about that. And the other bad part about an assumption is it usually takes a lot longer. And I had this conversation with Eric before. Why does it take so long to do an assumption? Because there's no priority. It's not new money to the bank. It's an existing deal. So it falls at the bottom of the pile. This may sound crazy, even though you're paying that 1% assumption fee. I'm telling you, it's a fact. I've been on the ends of assumptions before where you get kicked to the bottom of the pile. So, and if you're dealing with a purchase and sale contract that has time limits involved in it, that can really screw up your deal, especially if you got earnest money going hard. That's why you got to make sure when you write that assumption offer early on, you put provisions in there that protect that earnest money if the bank drags their feet, and they will. So an assumption is a way to get deals done. They're great if they have great terms. Excuse me. But the thing is, if the terms are not as good as they are today, you're better off just going out and getting a new money deal. But the existing borrower is going to say, well, forget about it. I can't sell it to you because I'm going to lose $500,000. So that's the issue with the assumptions. Um, Now, those are the 5 different ways that we were talking about. And I wanted to actually have Eric back on the line, but I think we actually lost Eric, unfortunately.
Can you hear me?
Oh, there
Can
you
you hear
are.
me on the? Yeah, I'm
Oh,
on the
good.
phone here.
I didn't know you were there, Eric. I've been doing this whole show by myself.
I was just enjoying it.
Oh, good.
Co-piloting. It's great.
All right. Well, let me tell you something, folks. Let me just kind of explain to everybody there exactly how you work, and maybe you can add to it as well. And this is something that might be unique and something that new investors need to understand when they're looking for loans in the multifamily world. Many of these investors are coming from the single family fix and flip. They're looking to get into the multifamily business, and they're taking their experience with single family mortgages and they're trying to apply it to the multifamily side. And it doesn't quite work that way. One of the thing is that, and this is the way it was explained to me. And Eric, you can fill in on this. The single family home mortgages, you can go to so many different banks all throughout your region and apply for a mortgage, and you apply to 30 different companies, you're going to get 30 different offers. On the multifamily side, though, it isn't that way, because behind the scenes, you're dealing with a limited number of resources. So can you kind of explain how that works, how that really is the difference between single family and multifamily?
Absolutely. Yeah. On multifamily or on single family, you've got a number of different lenders out there, where a broker is going to take an application and what they call shotgun it out. I mean, there's a lot of competition as far as your loan request. Commercial world is a small world. There's not as many. There's not as many lenders that are jockeying for your business, although they are competing with each other. I know I can see the same loan request come through a couple different times, and I always try to vet that out with my lenders very quickly. Say, you may have seen this deal, but here's what we have, and it's really where the relationship is formed, and knowing the 2 to 5 lenders that may have an interest in this deal because of its specific characteristics. So shopping is something you really, really want to be careful of. Absolutely, because it is a small world, and reputation in this community is important.
Yeah. So if it goes to you and 4 other guys just like you, then you take it to 1 or 2 dust lenders, and then they take it to their source, which is Fannie Mae. You've got potentially 8 different sources bringing the same deal to the one ultimate arbiter of who's going to get it.
Well, what it does really is limit you down the road. It's kind of like when you talked about putting seller financing in your purchase contract. You can't back out, because what Fannie's going to say is they're going to say to their lenders, the client needs to pick a horse. At the end of the day, we're gonna buy this loan from them. The client needs to pick a horse, and they can't make a concession for one lender that they don't make for the other lender. So what they're going to do is just cut it off and say, yeah, no concessions. this is a by the book cookie cutter deal. So it's going to limit our ability down the road to get any waivers or get any, not that we won't get the exceptions, but they're going to be across the board and they're going to be much tougher to get. So you kind of box yourself in. I'm not saying go with one lender and take the first offer that's given to you, but at some point there needs to be a solid relationship formed, somebody that you have a good working relationship with, and you need to pick it and go. That's key. If we keep wavering, or they see it come through with 3 different lenders, they're not going to make an exception for one lender and make it for another one. So it does kind of box you in.
Now, Eric, what exactly do you mean by concessions? What type of concessions can Fannie Mae give one lender versus the other, one DUS lender versus the other?
Well, technically they're not going to give any special treatment to one lender and not give it to the other. But if we're all one unit between the borrower, the broker, the DUS lender, and then eventually Fannie Mae's office, we all have open communication. They develop a level of comfort, and we're able to mitigate certain concerns that they may have, or we're able to highlight certain aspects of the property that allow us to maybe look at a little dip in occupancy, or look at certain replacement reserves that seem a little high at first, but we can mitigate those types of things, or even, let's say, borrower requirements, liquidity, net worth, things like that. We can highlight certain portions of them and maybe not fall prey to a rigid, very, very square box structure, because there is no such thing as a square box. I shouldn't say that. When you're talking about deals, they're all different, and there's no formula to it. It's all a recipe.
Okay.
So that's what I'm talking about, is when it comes in through 3 different lenders, they're pretty much just going to sit back and say, meet this criteria and send it in.
Okay, now we kind of lost you for the discussion on the bridge financing. Are you the guy to go to if anybody on the call needs to contact you regarding bridge financing?
Absolutely.
Okay. Okay, so that
Absolutely.
even though it's a regional program, or they're regional lenders, you have your go-to guys.
Equally as important, because you need to know where to go. I have kind of a standard system that I like to go by. With all of my clients, I like to have an initial consultation. Get together, get our heads together of what their program is, of where they're going to be buying, what dollar amounts, what type of performance of these properties they're looking for, and then they start putting out LOIs, and they know a general parameter of what type of financing is going to be needed or available for these properties. Once they catch something, that's when we have to talk and go through the purchase contract and talk about timelines, talk about finance contingencies in there, and really how they should dial in their numbers. Bridge lenders are very much like our investors, are like syndicators, like you guys, and they're raising capital just like you are, but they're raising it for the debt portion of the capital stack, and you're raising it for the equity portion of the capital stack. So they each have their own investor tolerances, or tolerances that those investors are willing to take. So remember, they're doing the same thing you are. They might stay in a specific region that they've outlined with their investors. They may stay in a certain deal quality, but more importantly, they have a minimum yield that they've promised to their investors. They're going to carve it up in a number of different ways. If it's 2 and 12, or it's 10 and 4, they can carve it up how it's going to work for you. But at the end of the day, they're still giving 14% to their investors minimum yield. So those are the items that we need to go through before you structure that purchase contract.
Okay.
That's why it's important. Bridge lending is very compartmentalized.
Now, Eric, let's kind of tell some more stories here about, what are some of the things that you've seen new investors just get roped in on, that you think that they should really be aware of, going forward and building up their investment portfolio. I'll start with what I consider to be the far end of the extreme. which I was at one of my weekend seminars, and this guy said, "I'm all set. I got all the money I need. I've got an investor that is willing to put up, whatever I need to get started." I said, "Oh, really? Who's this investor?" It was this guy that found me on LinkedIn. The guy that found me on LinkedIn, and I was like, "Oh, really? What did he have to say?" Well, oh, he's from London, and he's got like $20 billion, and he's looking to put it to work, and I can tap into it anytime I need to. And right away, I mean, I get these types of things all the time. I get them because I'm a lawyer. People send them to my law firm. There are all of these emails where people say, "Listen, I've got all this money. If you're looking to have it invested, I can take care of it for you." This what I remember the first time someone approached me with this. I happen to own a property, and it was a Nigerian ship captain whose daughter wanted to go to school in Cincinnati, where I had a property, and he was going to send me 1 year's worth of rent, and if she moved in, and so. The person I was working with said, "Oh, this is a scam. I've seen these things all the time." And I'm thinking to myself, how can this guy scam me if he sends me a check for a full year's worth of rent? And the way that it works is he'll send me a check, I'll deposit it into my bank, the funds at my bank will clear, and then a week or so after, he'll say, "Hey, listen, I decided not to stay for the whole year. Can you send me half of that money back?" And so that what people will do is they'll write the guy a check for half the money back before the bank finds out that the check was no good. And then you're out that money. So that's how these scams work. And the way to figure out whether it's a scam or not really is to go into the header of the email. And any email program will allow you to print off the header, and so that you can see what the IP address is of where that email came from. You go into a web site called whereismyip.com, put that IP address in there, and it'll tell you exactly where that email was sent. I can almost guarantee you they're all being sent from some place in Africa. So I see those types of scams all the time with people saying that they can get funding at unbelievable sources. So, Eric, have you heard any stories that what do you see new investors coming to you with that you just based upon your experience you realize that that's not all that likely?
Well, I mean, obviously the normal one, or the one you always hear about, is 100% financing. You really
Yeah.
want to watch that.
Yep. Exactly.
And really want to be clear on your expense deposits. I know we're kind of opening up a whole can of worms when we talk about upfront fees and such, but there's it's upfront fees and expense deposits are a rational requirement that have been abused, unfortunately, by some unscrupulous lenders. And it's found a lot in the bridge lending community because they do write their own checks. They go out there and look at the property themselves, so they don't have a real standardized form of an expense deposit. So it really depends on where the property is, what their schedule looks like, and how quickly it has to close. So you really want to take note of that. I wrote down two notes when you were talking about seller financing of things that you really want to be careful of. One is over leveraging. Sometimes I've heard people get very excited about being able to get, sellers offering me this deal with only 5% down. Well, you always want to focus on the permanent market because that's what you're going to refinance into. Focus on where you're going to land eventually. And if you over leverage this thing and you don't see the appreciation, that equity is going to have to come into this deal one way or the other. So always keep that in mind is don't over leverage and don't skimp on your third party reports. There's kind of a theory that I like to impress on all my clients is that remember that you and the lender are on the same side
Right.
of the transaction. You both want this thing to succeed. Your lender has got years of experience of seeing what deals work, and they also see what deals don't, and they track why they don't. So they're not just coming pie in the sky with these types of requests. They want certain third parties done for good reason, to protect you and protect themselves. So sometimes when you go into a seller financing deal, you're going to say, "This is great. I don't have to get anything but maybe
Right.
of an opinion of value done and all this kind of." You don't want to skimp on those third parties because it's very important. It's at the end of the day, it's protecting you.
Eric, I got to tell you, you just totally nailed. I have a client that it looked like we were going to have to litigate where it was exactly that situation. It was a seller finance deal, and she never got an appraisal, and she was not familiar with that marketplace, and it was her first deal, and she did not know that she was overpaying for that property. But the seller was expecting her to finance him out within 24 months. So she had to make that property turn and be able to comp out at a different value, but it never could because she failed to get a an appraisal early on because she didn't have to. It was seller financed, so it ended up costing her, almost cost her entire retirement. We were able to solve the problem, but it was a huge issue. And it just goes to that one thing that if you're doing seller financing, you still should do those third party reports because they are being done for your benefit. A survey. Why do you need to get a survey done? Because it's going to benefit you if it turns out that this seller has sold off part of the property, or if this seller has encumbered a portion of the property that you didn't even know about. Those third party reports are done for your protection. So don't. You're absolutely right, Eric. Don't scrimp on them.
Yeah, those are some of the areas that we really want to be careful of.
Yeah, and then also like you said before with the third party reports. I mean, with the over leveraging. I mean, I tell you, I've seen deals where a 40 unit deal that's purchased 75% loan to value versus a 200 unit deal that's purchased no money down, 100% seller financing. You make more money from that 40 unit deal than you do that 200 unit deal that barely breaks even every month because the debt on that property is so expensive. So, you got to ask yourself that question from a business standpoint. What exactly do I want to do? How exactly do I want to run my company? Do I want to just own property for the sake of owning property, or do I want to make a profit on this property? So, hey, Eric, we're coming up on the end of our time here, and I just wanted to thank you very much for giving us our time with you. And I know that we had an issue with the speaking. I'm going to try to get that cleared up so that doesn't happen again. But Eric, I put up here on the screen, if anybody needs to get a hold of Eric, I highly recommend them. Sometimes I'll throw people's names out there and say, listen, I'm not advocating this guy one way or another because I've